Good morning, and welcome to today's webcast, Realize Your Tax Benefits with IRC Section 382. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters for Moss Adams, Jennifer Menendez, Managing Director, and Chad Gumm, Managing Director. Jennifer has practiced public accounting at Moss Adams for over 18 years and leads the firm's Transaction Tax Projects Group, serving both privately and publicly held companies as well as private equity firms in several industries. Jennifer has extensive knowledge and experience in tax structuring, modeling, tax due diligence, Section 382, Section 280G, transactional cost analysis, qualified small business stock, and other transaction issues. Chad has worked in public accounting since 2001. He specializes in tax implications of mergers and acquisitions transactions, including tax due diligence, tax structuring, and federal income tax research, writing, and technical analysis. He has a deep technical knowledge of Section 382 net operating losses issues, determining of earnings and profits, stock basis, application of consolidated federal income tax rules, cancellation of debt issues, worthless stock losses, qualified small business stock, and Section 280G. So with that, I will turn it over to Jennifer to get our presentation started.
Thanks, Chad. Good morning, everyone, and thank you for joining us. Today, we're going to talk about Section 382 and 383 limitations on net operating losses, credits, and other attributes. We will start by going through why it is an important consideration, including a general background and overview, and then we will go through some key terms and a general overview of determining when or if an ownership change may have occurred. Then we'll go into some time talking about identifying 5% shareholders and then going through the limitations that could apply once you have determined that an ownership change has occurred. And then we'll do our best to leave some time at the end for some question and answer time. Okay, so first we have our first polling question.
Thank you, Jennifer. And we have our first polling question of the day. How would you define your experience with Section 382? Either A, I've never heard of it, B, familiar with it, but have never dealt with it, C, have done some analysis, D, I'm an expert. So if you select the answer on your screen and hit the submit button, your polling question will be recorded for today's webcast. You will need to answer 3 of the 4 polling questions today to receive your CPE credit. So we'll give you about 15 seconds or so here to answer this first one. All right, it looks like we're already to 90%, so we'll give you about 5 more seconds. All right, let's check out the results.
All right, so it looks like a good mix, and I think for some of you it'll be a good refresher, and for some of you that have never heard of it, hopefully it'll be a good high-level summary for you as well. With that, we'll go ahead and jump in. So why is Section 32 an important consideration? Section 32 was enacted in a time where companies were selling their stock in order to sell their NOLs rather than the underlying businesses. And at this time, Section 32 was enacted in order to prevent what Congress saw as, an abusive practice of trafficking in loss carryovers. However, the rules that were enacted are very detailed and complex, and an ownership change and the related limitations can get triggered by much more than the abusive example of trying to sell NOLs. So this could be whether there's multiple rounds of equity investments or a straightforward sale of the company. When it does apply, Section 32 limits the amount of NOLs, net unrealized built-in losses, tax credits, and interest carryovers that were accumulated prior to the ownership change that can then be utilized to offset taxable income or tax after the ownership change. And it's important to note that when there are multiple ownership changes, it can create multiple pools of NOLs where the lowest limitation will apply. In other words, triggering a successive ownership change can only produce a worse result, not a better one. So even if you have a recent transaction or something that is an ownership change, it's still important to go back historically all the way to the beginning, and we'll talk about that a little bit more later, to analyze if there's any previous ownership changes as well. So there's a few common situations where we see companies really needing to go through the process of looking at Section 382. So first is in just tax return reporting. So if the company is starting to generate taxable income and needs to utilize their NOLs, credits, or other attributes that they've accumulated in the past, then usually both the company and the tax preparer will want to get comfortable with the availability of those NOLs under Section 382 prior to signing a return that's utilizing them. So we saw this a lot last year with the new Section 174 rules, which required the capitalization of research and development costs, where a lot of companies that historically had generated losses, they suddenly had taxable income for the first time and then needed to utilize some of those losses to offset that income. So that's just an example of where we're seeing the need for Section 382. And then the second is in transactions. So when a company is considering a sale, they may want to try and negotiate some purchase price value for any NOLs or credits that they're currently carrying forward. That buyer will then be able to potentially utilize and receive a tax benefit for. So in this scenario, often if no Section 382 analysis has been completed, a buyer will usually default to ascribing no value or very little value to those attributes. So it's important to be ready to prove to what extent the attributes are available or could be available, and could provide that value to a buyer before you enter into those purchase price negotiations. Also, if a company has historically utilized any NOLs or credits without doing a Section 382 analysis, then this could be a historical exposure item that could come up in tax due diligence and cause issues with the deal. So third is financial statement reporting. So in a company's financial statements, the income tax footnote will usually include the tax value of any NOLs or credits. So even in a scenario where those attributes have a full valuation allowance against them, it still may be a disclosure issue or an uncertain tax position if there could be a Section 382 limitation that would impact the value of that gross amount of attributes. So usually when this happens is when there's an ownership change or changes with a limitation that's low enough that the NOLs could not be fully utilized prior to their expiration. So with the more recent NOLs that don't expire, we don't see this issue as much, but it could be that, maybe they'd be spread out over so many years that it'll impact the decision on valuation allowance. So fourth is just general tax planning. If the company has multiple rounds of financing and is continuing to issue equity, it may be important to understand where the current cumulative ownership is at in order to evaluate new financing rounds that could potentially trigger an ownership change inadvertently. So especially where, we've seen with public companies, for example, where they put, agreements into place to limit the activity that shareholders can do once they hit, to get to that 5% level. If they're kind of at that 40 to 50% range already and could easily trip over the 50%.
Hey, Jen, I just want to jump in here real quick.
Sure.
One thing I wanted to add on the first bullet point on the tax return reporting, the tax rules actually technically require any corporations that are quote unquote loss corporations that have NOLs to do it on an annual basis. And if you're familiar with this, if you have NOLs or tax credits, the rules require you to add a statement to your tax return to report certain items related to this, including, if the company's experiencing any ownership changes during the year. But of course, unless a company is required to, it's very common in almost all cases that if one of these categories doesn't apply, you kind of kick the can down the road and you don't do it on an annual basis. So that's very common, despite the rules wanting you to do this on an annual basis. And so what happens is, companies, if you're not facing any one of these four categories, you could go many years without performing a Section 382 analysis. But once you then now face one of these categories, then all of a sudden you do have to do an analysis for all the years that you haven't, and which we'll get into a little bit later. But it's just kind of important to note that you have to start the analysis from when you first started generating losses, because that's how the rules apply. And then finally, just on the financial statement reporting, if your company is going through an audit review from an independent auditor, a lot of it depends on who the audit team is, and sometimes they push to say, oh no, we want you to qualify your NOLs because it's a deferred tax asset that's going on your financial statements, and sometimes it's not. It's if you're a publicly traded company, typically we find that the auditors push for this more so than when you're in a privately held company. But even in those cases, it's all case dependent upon it. But nevertheless, when you kind of experience some of these big ownership changes, they'll definitely force you to do the analysis if you haven't done one previously. Sorry, Jen, go. Didn't want to.
No problem. Thanks, Chad. All right, so next we're going to go through just a general overview of 382 and some key terms. In doing this, you'll kind of see that it's like every definition of a term has more key terms in it. And so we'll do our best to kind of go through each of those that do apply. So the first one being a loss corporation. So we need to determine if the corporation is considered a loss corporation, to which Section 382 applies. And this includes any corporation with attributes that are limited by Section 382, including net operating losses, net unrealized built-in losses or new bills, disallowed interest carryovers under 163J. It also could include attributes that are limited by Section 383, which includes capital losses, general business credits, which most commonly we see as research and development credits, minimum tax credits, and foreign tax credits. And this includes if the company has any of these attributes that are generated in the current year, but also if they have any that are carrying forward from a previous year into the current year, then for that year, they're considered a loss corporation. And we'll talk about new bills in more detail later, but at a very high level, this is when the aggregate tax basis in the assets exceeds the fair market value of those assets by more than an established de minimis threshold. So in order to determine if any limitations apply, the company must first determine if an ownership change has occurred. And this involves analyzing all testing dates, which we'll go through on the next slide, in order to determine the extent to which each 5% shareholders percentage owned has increased over their lowest percentage owned in the testing period. So to the extent that all of those increases aggregate to more than 50%, there is an ownership change under 382. And note that for this purpose, you only add the increases and you disregard all decreases. Further, it's important to note that the percentages owned must be determined based on fair market value rather than just a number of shares or fully diluted shares when there are multiple classes of stock. So one other note is that there are very detailed rules, which Chad will go through later, that group the less than 5% shareholders into what we call public groups. And then those public groups are then treated as 5% shareholders. So as we mentioned, 5% shareholders throughout this presentation, we're also including those groups that are then treated as 5% shareholders. So the most straightforward scenario where you trigger an ownership change is if there's a single 5% shareholder or group of 5% shareholders that purchase more than 50% of the fair market value of the outstanding stock, such as in an acquisition transaction. Maybe one buyer is coming in, purchasing 100%. That's obviously an ownership change. But as mentioned, this can also occur over time through multiple equity raises or other transfers as well. So as mentioned on the last slide, in determining when or if an ownership change has occurred, you have to determine the percentage owned of each 5% shareholder at each what's called testing date. So a testing date occurs anytime that there is an owner shift or an equity structure shift. An owner shift is any change in stock which affects the percentage of stock owned by a 5% shareholder. So this can include any issuance of stock, even if it's not to a 5% shareholder, because that it changes the percentage owned by the 5% shareholders. It also includes exercises of stock options, sales or transfers of stock that are to or from a 5% shareholder, redemptions or recapitalizations. It does not include any transfers or sales between less than 5% shareholders. And then an equity structure shift is any 368 reorganization, excluding any A1, D, G, or F reorganizations. So then in measuring the cumulative shift at each testing date, you aggregate the positive shifts when comparing the percentage owned on the testing date, again, to their lowest percentage during what's called the testing period. Initially starts on the first day of the first taxable year in which the company becomes a loss corporation. So whether that's if they've always had losses, that'd be the first year when they're incorporated, and it would begin at the very incorporation date. If you haven't always had losses, it'll begin at the first day of that tax year when you first generated a loss. And then it is generally a 3-year rolling period from that date, but it restarts when an ownership change occurs. So because of how that period restarts at an ownership change, it is very difficult to try and go backwards in time, and you generally have to start the analysis from the very beginning. And we'll talk about that a little bit more later as well. With that, we'll go to our next polling question.
Great. Thanks, Jen. And our second polling question of the day, what brings you here today? Either A, my company has accumulated NOLs and is anticipating taxable income in the near future. B, my company has accumulated NOLs and is anticipating a transaction in the near future. Or C, I have questions about how 382 might impact my company's deferred tax footnote and audited financial statements. Or D, none of the above. I'm just here for the CPE. So if you select your answer on the screen and hit the submit button, your question will be recorded. I'll give you about 15 seconds or so to answer this one. We're about 92%, so we'll give it about 5 more seconds here. All right, let's check out the results.
All right, great. Looks like we've got a good chunk here for the CPE, and that's great. And then some of you, it's kind of split between the other 3 as well. And with that, I will turn it over to Chad to talk about 5% shareholders.
Okay, and for those of you that are just here for the CP credit, we'll try to make this as entertaining as possible, so it's not completely boring. But in any event, thanks, Jen. So what we're going to do in the next few slides, we didn't want to get too deep in the weeds and the technical aspects, but we did kind of want to hit on some of the common terms and rules that apply that really dictate, how it applies to every corporation that has these losses, and whether or not you trigger an ownership change. So again, just to be clear, in any Section 382 analysis, there's 2 kind of phases of the analysis. The first phase is the ownership change analysis, determining when or if, but usually when, a company triggers an ownership change. And a lot of times companies that have been around for some period of time, particularly if they've gone through multiple financing raises and other types of shifts in ownership, issuances of stock, repurchases of stock, share transfers, whatever, especially if the company's got, is publicly traded and you're issuing stock, and now you got public shareholders that have a public market to trade and sell, buy and acquire and sell stock. You can experience multiple ownership changes, which again we'll touch on a little bit. So that's the first phase. Then the second phase, which we'll get into a little bit, is okay. Once we identify the ownership changes, each ownership change results in a Section 382 limitation, and so you have to calculate that. So that's part of phase 2, which we'll get into shortly. But in the first phase, it's just determining when the company's experienced an ownership change, and what the rules here, and Jen kind of touched on it briefly earlier, where when Congress was coming up with these rules and then drafting these rules, it was quickly evident that if you try to come up with a simple set of rules, that there'd be big loopholes to get around these rules without triggering an ownership change. So when they drafted these rules, and I know there's a lot of jokes about tax loopholes. Well, this is one area where I think that there's very little loopholes. They've done a really good job making sure you can't in-run these rules. And so the unfortunate downside is they're very complex, and there's a lot of moving variables in order to determine that. One of those areas is just who do you track to determine your ownership changes? And one of the main components is what they refer to as 5% shareholders. So this is, again, any shareholder that owns 5% or more of the company's stock based on value. And so those are the shareholders that the rules want you to track specifically. And so, if you own 5% or more, you have to track that shareholder's increases or decreases, and if they're selling stock, acquiring stock, and how that impacts the overall company. Then you take an aggregate. So let's just say you had a shareholder that owns 5%, and then they acquire an additional 3%. So now they own 8%. Well, that's a 3% increase. So then you take that 3%, aggregate all the other shareholders' increases, and if collectively within a 3-year period that goes over 50%, that's when you trigger an ownership change. So then in the next few slides, we'll touch on a little bit of the complexities around what does a 5% shareholder mean. So the first thing is indirect ownership. So the one I thought many years ago when someone was teaching me these rules, the one thing that they're really trying to get to is what's referred to as the heartbeat rule, is that these rules really want to understand where is the individual that owns the economic rights to the corporation. And that individual ownership may be through a tiered entity structure. It could go up, multiple tiers. And so what the rules require you to do is kind of look through entity shareholders and keep on going up the chain as far as you need to get to till you get to an individual. And then you test whether or not that individual is a 5% shareholder, either indirectly, just through that, vertical indirect ownership, or indirectly and maybe directly if they own shares directly and indirectly through a chain of ownership of entities. And then test whether or not they own 5% or more. If they don't, then you kind of group them in with everyone else that doesn't own 5% or more, which we'll touch on in a second. And so what the rules do is they place a duty of inquiry on the company to try to identify this information. And so if you haven't satisfied this duty, you haven't completed what the rules require. And so often we'll do this where we'll send these inquiries because if we're looking at a direct entity that owns stock in the loss corporation, well, we don't know what the ownership of that entity is. So you kind of have to keep on going up the chain to look at the indirect ownership. And so what we'll do is we'll send inquiries to that entity shareholder and say, what is the ownership of your entity? And were there any shifts in ownership there that we may need to track to determine whether or not the company has experienced an ownership change? And so it can get really complex and challenging quickly if it becomes an issue. And so the company does have that duty of inquiry. Now, for public companies, obviously public companies are also subject to SEC reporting requirements, where the shareholders are, if they own 5% or more, and I'm not sure if that's where this 5% rule came into place. They kind of piggybacked off the SEC reporting requirements. But if you own 5% or more for SEC reporting purposes, you have to file a Schedule 13 with the SEC. And so these rules say you can rely on those filings or the absence of those filings to determine, who your 5% shareholders are. And so for public companies, we'll review all the Schedule 13 filings, and sometimes the information, includes all the information that we're looking for. But again, it's for SEC reporting requirements, not for tax reporting or specifically 382 reporting requirements. So oftentimes it does not contain all the information that we're specifically looking for. Now, with that being said, I'll say that the more recent filings in the last 5, 10, 15 years is much better than it was, say, 20, 25 years ago, where the reporting was all over the map. But now the compliance departments for these particularly the big public investor funds have gotten much better, especially with some fairly recent IRS rulings that have kind of indicated what they're looking for in some of these filings. Now they know what to do, and those will include that information, but that's not always the case. So sometimes even with those filings, we need to follow up or want to follow up if we can get maybe a better result than what we're seeing just simply from the filing. And then just lastly, for the 5% shareholder groups, the rules don't include investment advisors. What the rules again want to look at is who's the economic owner of the shares, not just who's on the paper ownership of the shares. The most simple example of this is if you have like a stock advisor who has multiple clients that are just have wealthy bunch of money that they want to invest in the stock market, but they don't know anything about investing, and so they get a stock advisor to help them. He collects all their money, pulls it together, and goes off and invests in public company X, and thinking that's a good investment. But so for SEC reporting requirements, that stock advisor's name is going to be on the stock because he's buying it kind of in his name or whatever entity that he's working for, they're going to be on the ownership of the stock, but it's kind of in name only. It's really for the benefit of the clients. And so if that's the case, maybe as when it collectively as a group, they own 5% or more and now need to file a Schedule 13, but really they're just an investment advisor, and we can ignore that. And if none of the individual clients own 5%, we can ignore that kind of group entirely to some extent. So now there are also constructive ownership rules to know, where they'll particularly for family members, and then also some other ownership of like trusts and whatever, that the rules require you to kind of group certain related parties as one and test whether or not that group of related shareholders is a 5% or not, and track them as a group rather than separately individually. And then same thing for coordinating acquisitions. Oh, there's a placeholder thing there. So let me explain what that means. And so this is where you have related funds, or oftentimes related entities, that are making coordinated acquisitions, and the rules require you to group those multiple entities as one. We typically see that with like your venture capital funds, where they're investing in companies, and usually they do it through multiple, like 2 or 3 different funds. They do it at the same time. There's one group that's making investment decisions on behalf of all the funds, and it's like split up for either tax or non-tax reasons why they split them up into multiple funds. But nevertheless, the rules require us to treat them all as one shareholder. And then finally, and Jen mentioned this earlier, is that the rules kind of focus on tracking 5%, anyone that owns 5% or more, so you're 5% shareholders. But what happens for shareholders that don't own 5%? And this is a common misunderstanding, is that when you kind of sort of understand the rules but don't fully understand the rules, where people think, oh, I just need to look at anyone that owns 5% or more and just look at them, and I don't have to worry about anyone that owns less than 5%. Well, that's not the way the rules work. What they do is they say, okay, if you own 5% or more, you have to track that shareholder specifically. But anyone that doesn't own 5% are going to kind of be grouped all together. So you're kind of your non-5% shareholders. And they're all going to be grouped into what's referred to, and Jen mentioned earlier, as public groups. And the public group is going to be treated as a 5% shareholder, even if the public group does not own 5% or more. So even if it just is, all the non-5% shareholders only make up 3% of the company's stock, that's a public group, and that's going to be treated as a 5%, even though they only own 3%. But then there's aggregation and segregation rules. There's very specific rules of how you allocate shares to a public group, or take shares away, allocate shares away from the public group. And this is how you end up creating multiple public groups. And so a lot of times we go through our analysis and we'll end up creating multiple public groups within the analysis. And this is the reason why, because there's very specific rules. So it kind of almost says, we're not going to necessarily follow the actual rules. We're actually going to just group all these non-5% shareholders in these public groups and apply these kind of separate rules of how we track them, rather than actually like, oh, this one shareholder that owns 1%, you now acquired 2%. We're going to track them. It's like, oh, no, you're in the public groups. And if there's an additional issuance of 2%, these specific public group rules will apply to say, how are we going to allocate that 2% to the public groups rather than, to that specific shareholder? Because again, once you're kind of a non-5% shareholder, we're no longer tracking you specifically. We're just going to apply these specific aggregation and segregation rules on how you track them. But there is an exception for actual knowledge, which can be very complicated, and generally I don't see applied very often, but the rules are there to apply actual knowledge. But usually we only see that in very, very simplistic companies with limited number of shareholders. So that's the kind of again, kind of part of the first phase of the analysis, identifying when the company's experienced an ownership change. The second phase, as I mentioned, is when you identify an ownership change or multiple ownership changes, you have a Section 382 limitation. And so this is really the crux of like, if you're like looking at, I want to know how does this impact me? This is the analysis that's going to impact you on how many NOLs or tax credits or whatnot you're going to be able to utilize in your current year and future years, assuming no future ownership change, which could obviously change things. So basically, it's an annual limitation that says, here's how many of your limited NOLs and tax attributes are subject to the limitation, how much become available for use in a given year. And so there's a base limitation that we'll kind of go into an example in just a second. That generally applies based on the value of the company multiplied by a tax exempt rate that the IRS publish every month. They publish that, and then there's some various different adjustments which we'll see in a second, and how that the value can adjust and how that base limitation can be impacted by some of the additional rules. And then there's the net unrealized built-in gain or loss, and the impact on that can either increase that annual limitation or apply more to the NOLs losses. So really quickly, here's a simple example. Let's just say a company had an ownership change at the end of last year on December 31st. The company value, like the market cap, purchase price, whatever, valued at $50 million. Here we kind of listed some potential adjustments to the value. I'm not going to go into in depth on any of these, but these are generally the ones that would apply, that typically adjust the value downwards potentially. So you kind of got to check the box, make sure that none of these apply, or if they do, adjust the value. And then the applicable federal rate for December of 2023 was 3.81%. You could just Google that Section 382 rate for whatever month you're in, and it will pull up that what that percentage is. And it's published every month by the IRS. And so if you have an ownership change, like here, if they had an ownership change in December of 2023, you would apply that 3.81%. So you just take the $50 million market cap value to be TBD on the adjustments. So assuming there are none, our Section 382 value is $50 million. Then we apply the applicable federal rate of 3.81%. So our base annual limitation is $1.9 million per year. So that means basically the company frees up $1.9 million of its NOLs or other tax attributes per year in the future until all of the attributes that are subject to that limitation free up. So now I'm going to touch on these new bill rules, and this gets really complicated, so I don't want to dig too much into the details here, but really what a new big is a net unrealized built-in gain, and a new bill is a net unrealized built-in loss. So typically we see more net unrealized built-in gains, which is a good thing. Then unrealized built-in losses, not such a good thing. That's usually for troubled companies that with their values going down, but nevertheless can apply in situations where companies like starting to face bankruptcy or other troubled situations. So again, really high level, where the new big is where you look at all the assets, you look at the fair market value of the assets and the tax basis. And if you look at it, there might be some built-in gain assets, there might be some built-in loss assets, but collectively in the aggregate, if you have an overall net unrealized built-in gain, then you're in kind of the new big category. And if it's an overall new bill, then you're in the new bill category. And the threshold of whether or not these rules apply is just whether or not the new big or new bill exceeds the lesser of either 10 million or 15% of the value of the assets, which is really honestly is not a very high bar to satisfy. So I'd say in nearly all situations we end up having to apply these rules, which again, if you're in a new big situation, is typically a benefit, and which we'll see in a second. So again, just real quick, for determining whether you're new big, you track it on an asset by asset basis. And if you have a new big, then and these are kind of like the general rules. If you trigger any of the built-in gain assets within 5 years of your ownership change, you get to increase your annual limitation, your base limitation. If you're in a new bill situation, it's really different. It's not like you don't decrease the limitation. What happens is when you trigger the built-in loss asset, let's just say ownership change happens again in 2023, and then you sell, and you're in a new bill situation as of December of 2023 at the time of the ownership change. 2 years later, you sell the built-in loss asset. That loss is going to be treated as if it was triggered before the ownership change and be subject to that base limitation. So very different rules if you're in the new big category or for the new bill category. So you definitely want to be in the new big category. So now these rules will generally, the kind of standard or general rules apply only if you, so if you're in a new big situation, for example, I'm going to focus on new bigs because that's the more positive aspect. If you have in a new big, then if you sell your asset and you trigger the built-in gain, you get to increase the limitation by the built-in gain that existed at the time of the ownership change. So that could be a very favorable thing. What happened was when they first published these rules in 1986, they had these rules, and there was also a clear dichotomy between companies that triggered an ownership change that were in a situation where they could sell their assets versus companies in most situations that could not go out and sell their assets within 5 years of an ownership change because you need your assets to operate your business. So it kind of provided a distinct advantage to just companies that were randomly in a situation where they were in a either selling mode or they could sell certain material assets that had a built-in gain to achieve this benefit. So in 2003, the IRS, I think, relented to some pressure and published this notice that then allowed taxpayers that had either a new big or new bill, but again, more focusing on the new big situation, these different approaches to potentially get a benefit from your built-in gain assets, even if you don't sell the assets within 5 years. And so there's these two different approaches. And generally, the 1374 approach that we mentioned here is usually only used for if you're in the new bill situation, because you don't want to trigger and apply that because you're in a new bill situation. Or the 338 approach, which is much more common and typically used if you're in a new big situation. And what this allows you to do is take a benefit of this, even if you don't sell your assets within 5 years of an ownership change. You don't get a full benefit of the built-in gain in the asset, but you get some, so which we'll see here in an example. So let's just say, again, ownership change happens at the end of 2023. The value of the company is 50 million, and the added fact is the company's got 60 million in NOLs. And here's kind of just a very simple balance sheet: 2 million in cash, 3 million of accounts receivable, 16 million of fixed assets. And the big thing is that it's intangible assets. $36 million fair market value. It's all self-created, intangible asset, goodwill value that has zero basis. So the overall built-in gain, you're in a new big situation, and that's going to allow you to get that benefit. So here we see this. Again, remember our base limitation is 1.9 million. Here, if we had intangible with a $36 million built-in gain, even if we have fixed assets that had a 2 million built-in loss in it, your overall new big of $34 million. So now we're in a new big category. So then what it does is say, okay, if you're in a new big, take your built-in gain asset, which here is our intangible asset, what would happen if you stepped up that basis to fair market value? Well, you'd get to amortize that over 15 years under the normal tax rules. So you're going to get 1/15 benefit each year for 5 years. So you can see that if you divide 36 by 15, you get 2.4 million. So you can increase your base limitation of 1.9 million by 2.4 to get a total annual limitation of 4.3. So that's going to be free up 4.3 million of NOLs per year rather than just 1.9 of base limitation in this example. After 5 years, you no longer get that RBIG benefit, so you're just left with the base limitation after year 5. So you can see if the company has 60 million of NOLs, you can free up in 5 years roughly 20 million of those NOLs, and then after that you're just freeing up 2 million a year for the next, until you free up the remaining 40 million in this scenario. So with that, we'll touch on the next polling question.
Awesome. Thank you, Chad. And our third polling question of the day: would you anticipate your company to have a large portion of the value attributable to intangibles such as notice 2003-65 would be important? Either A, yes, B, no, C, not sure, or D, it is not a loss corporation or otherwise NA. So we'll give you about 15 seconds here to answer this polling question. If you just select your answer on the screen and hit the submit button, your polling question will be recorded. And we'll give you about 5 more seconds here. All right, let's check out the results.
Okay. We got some yes, some no, and a lot not sure, and a few not applicable. All right. So next we're going to touch on, as I mentioned, multiple ownership changes. So, as I alluded to earlier, a lot of times companies experience multiple ownership changes. So when I think of a limitation, just to put this in, like, analogize it and put it into like a picture context, what I like to think of it is a limitation is, think of like your NOLs are in a bucket, and at the bottom of that bucket is a hole that leaks the NOLs, or like water, like NOLs that are leaking through that bucket. And depending on how big or small that hole is, the NOLs will, drip out of that bucket, and which is your annual limitation. So if you have a large annual limitation, all the NOLs that are in that bucket are going to drop out of that bucket and become available for use quickly. Or if the hole is really restrictive, the NOLs that are in that bucket are going to dribble out of that bucket much more slowly and become available, over a long period of time. And so what happens, though, when you have multiple ownership changes, over the history of the companies, as they were generating and carrying forward losses or tax credits or attributes, is that you've got multiple buckets. So if you think of it, let's just say, very simple example, company experiences 3 ownership changes, one in 2020, one in 2022, and then a third one in 2024. You're going to have 3 different buckets, which are kind of tiered. So your first limitation is at the very top bucket. And so the NOLs that were generated through like 2020 are going to be in that first bucket. And then depending on what the annual limitation of that first limitation, that's going to, fall out of that first bucket into the second bucket. And then you've got your annual limitation of the second bucket. Again, could be smaller, could be bigger. And then all of the NOLs that are in that second bucket, including the NOLs that have now dribbled out of that first bucket into the second bucket, are going to have to drop down into that third bucket. Finally, once the third bucket, that annual limitation allows those NOLs to kind of drain out of that third bucket, that's when you can actually utilize the NOLs. So it can get very complicated quickly, depending on how many NOLs are subject to each limitation or in those buckets, and how either big or small or restrictive that limitation or that hole is in that bucket will dictate, say in 2024 or in future years, how many of the NOLs or tax attributes the company can utilize in any given year. And so the more limitations or more ownership changes and therefore more limitations, the more kind of complicated it can become. And I've seen, in my history doing hundreds of these analysis, I've seen, it's very rare, but sometimes a company doesn't experience any ownership changes. Usually it's 2 or 3, but I've seen anywhere from 7 or 8 ownership changes. That's usually on the very high end and pretty rare, but nevertheless, it can happen if the company's been around for a while and had a lot of shifts in ownership over the years. So common, pitfalls. Again, tracking the shares. Tracking shares rather than fair market value. Now, if the company only has one class of stock, it's not an issue. I'm sorry, Jen. I'm interrupting Jen. This is your slide.
No worries. Thanks, Chad. I'll try to go quickly through these, but we just wanted to talk about some common pitfalls that we see in Section 382. And some of these we've already mentioned throughout, but just want to reiterate because we see them and they're important. Like Chad just said, I think we commonly see tracking shares rather than value. And so it is very important to consider the value when there's multiple classes of stock. The second is ignoring the less than 5% shareholders or just treating it all as one public group. Because the kind of default rule creates a new public group and a new shift as of every testing date when exceptions don't apply. If you're just grouping them all together or ignoring them, it could basically come up with a very wrong answer, and you're missing a big part of the shift there. Another issue is just starting at an arbitrary date, or like I said, trying to go backwards to do the analysis because of how it restarts with an ownership change. If you try to just go backwards the 3 years, you might not get to the correct answer because you could be missing, in that 3-year period, maybe a year in, there was actually an ownership change that occurred if you go 3 years from that date. And if you miss that restart, you're not going to get to the right answer. Calculation, we've seen where companies calculate the limitation based on a post-money value. So when, let's say you have a big round of preferred stock that triggers an ownership change, in that scenario, you're not allowed to include the value that came in with that ownership change. So if you include the post-money value, it's going to be a highly inflated limitation. And again, not accurate. You're going to have a much lower limitation than you think. Another related issue to that is there is a reduction for corporate contractions, and where we see that missed a lot is any debt pushdown can be treated as a corporate contraction. So just something to look out for because sometimes that can really reduce that limitation. And then missing the closing of the book selection because a lot of companies, as we talked about, might push off doing the analysis until actually utilizing the NOLs. The closing of the books election can get missed as it needs to be filed on a timely return, for the year that the ownership change occurred. And absent that election, the NOL for that year is allocated based on, pro rata number of days. And so there are scenarios where it's, making that closing of the books election can be very beneficial if it pushes, depending on the seasonality and when the NOLs are incurred before or after the ownership change. And then just some key takeaways from today. It can be very difficult to determine who the 5% shareholders are, requiring, looking through entities, like Chad said, inquiring with investors, applying the rules and the exceptions, to the less than 5% shareholders. And then it is very rare to see a situation where it is possible to do a shortcut or high-level method of preparing an analysis that is reliable because of how complex the rules are. I think, I've seen a couple situations in my career where it is possible, where maybe one individual owned more than 50% historically, always, throughout time. But I think that's the exception. And most of the time, it really does need to be a more detailed analysis. And when we see people trying to shortcut it, it usually ends up incurring more time and, in the end to get to the correct answer. And then value is a very important factor throughout. So both in determining when or if an ownership change has occurred, and then also in, determining the limitation that applies. And then there are several factors in determining the 382 limitation. Like we mentioned, several adjustments and looking at new big and new bill. So it isn't just as simple as taking, equity value times a rate. All right, I think this is our last polling question.
Thanks, Jen. We have our last polling question. After this webinar, do you have a better understanding of Section 382? Either A, yes, B, no, or C, maybe. I'll give you about 15 seconds to answer this question. If you select the answer on your screen and hit the submit button, your answer will be recorded. All right, we'll give everyone about 5 more seconds here on this one. All right, let's move on to the results.
All right, well, that's great. I'm glad that most of you feel like you have a better understanding. We're going to move on real quick to, just wanted to spend a couple minutes talking about our transaction tax projects group here at Moss Adams. Focus on complex corporate transactions, complex corporate transaction projects. And that includes like 382, like we talked about today, 280G parachute payments, transaction cost analysis, qualified small business stock, EMP, and stock basis. And this webcast is part of our 4-part series on these transaction tax projects. And, please join us for our next webcast, which is going to be August 27th, and that's going to be on transaction cost analysis. With that, I think we only have 2 minutes left. We've got a few questions that came through. I think we probably will need to just follow up separately on those. There's one you're talking about, is it possible to have new big when base limitation is 0? I'd say yes. At the time that I've seen that is more when it's, maybe the equity value is 0 or close to 0, but maybe there's debt. And so when you take the equity value plus value of debt, there's actually value to the assets there. And so you could potentially have a new big when the base limitation is 0. And I think the rest on this chat, I don't know if there was any that you wanted to quickly respond to. Otherwise, I think we're going to have to just follow up with those.
Chad, I think you're muted.
Oh, sorry. There was one other question on just whether or not you could sell assets from a loss corporation to realize the gain to get the benefit of the built-in gain. That would be challenging to do that if you're selling within a related group context. But certainly if you're selling to an unrelated party, that would certainly be able to, you could benefit from that built-in gain in that asset, but it would be challenging to do it in a related party context. But there are situations where that has been applied, particularly for like multinational companies that have, want to send assets, from the U.S. overseas. You trigger the built-in gains in those assets, and then you increase your annual limitation, and allow you to utilize more of your NOLs to offset the gain. So that's a situation where it can apply. So with that, I think we're finished.
All right. Thank you, Jennifer and Chad, for a great presentation today. If we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all the certification requirements, your certification is available for download now in the CPE progress window. I'll keep the webcast open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.